All right, guys, we've got the latest weekly update, Shop Talk Part 2 with Anna Sepic. She's VP of Land and Multifamily here at Levrose. So if you've got any questions about those specific asset types, reach out. And today we're actually going to be talking about something that honestly is coming up more in conversation with a lot of our sellers and buyers, just as interest rates are rising. And we're going to be talking about seller carries today. So we'll have Anna kind of talk about everything of seller carries in a nutshell.
All right, thanks, Mark.
Yeah.
Landon, good to see you guys. Seller carries have really been coming up, especially where interest rates have been going up. And we've seen the rate hikes now, 75 basis points, with the elections results fairly in. Everyone and kind of the jobs report is expecting most likely another rate hike. What does that mean for real estate? What are we seeing in the deal structures? Debt is harder to source. Mm-hmm. Lenders are getting tighter on underwriting requirements. The lowest we've seen right now is about a 1.2 debt coverage ratio. That's a really low end. Most lenders are right now at a 1.25. So when we're talking about looking at opportunities on how do we get deals done, we want to focus on property owners that have lots of equity in the deal. Not just the artificial equity, but they've owned the asset for a long time. They either maybe have low debt or they have no debt at all. So how do we structure the seller financing? We want to make sure that those sellers, in order to get their premium, their carry rates have to be a little bit lower than what market rate traditional financing would be today. That's how we're able to incentivize sellers to maybe structure a deal and look at, okay, hey, maybe you don't want to do a 1031. You still want to have consistent cash flow coming in. Here's an opportunity to look at alternative financing measure using the seller carry method, do a traditional promissory note, look at like the rent assumptions.
I think, who's this for at the end of the day? Is this going to be a buyer that's, kind of locked out of traditional financing because of the rate hikes? And now we've got to look at alternative sources of, how can they put debt on this thing?
So if you're looking at how to put debt, right? The interest rate now is at about, let's call it a 6.25.
Sure.
To 6.5. Okay. That was typically the carry rates when the market was down where you could source debt at, let's say, a 3 to 4%.
Right.
So now we're looking at the inverse, right? If you have a seller and cap rates were so low, what happened now with debt going up? We have cap rates going up, our debt has gone up, but sellers still are in this expectation mode of pricing, right? And if you want to reach a specific price point, what do we have to do? We have to finagle the financing side, right? Yeah. So if you're a seller that wants to net $3 million on your property, having this cap rate have gone up almost 200 basis points, alternatively for them to get this $3 million price point, let's say that they're offering a 4 or 4.5% interest rate on a seller carry.
Yeah.
That's able for them to still get this number and open up the door for maybe more potential buyers to get them if they're set on a specific price sale point, if that makes sense.
Yeah. And I guess like with the basics of the seller carry, so the seller of the property becomes the bank.
Correct. Yeah. And a lot of people don't necessarily like to think in that, but it really works, right? So if you set it up exactly as the way you would with traditional financing, the seller is the lender. They set it up with a promissory note. You have your general deed of trust for the transfer. Whether you do the special warranty deed or the regular warranty deed, doesn't matter how you structure that. But your seller has the amount, let's say they want 20% down.
Yeah.
Or they want 25% down, which is great.
Way more favorable terms than traditional debt. So
yeah, and obviously right now too, we're seeing banks require a bigger down payment with them getting a little more careful about their financing terms. Are we seeing that in seller financing too, or is 20 to 25% still standard?
Well, it depends on the risk tolerance of the seller, right? So if you have, the reason banks are requesting more is because we got to, again, reach that 1.2 to 1.25 debt coverage ratio.
Yeah.
If you're a seller that's not necessarily interested on your debt coverage ratio and you're not underwriting the buyer in those terms, and you're specifically looking at, I want to get my price here, and you're willing to go to something that's here or even 30%, that's still more favorable than having to put 40 or 50% down. And now you're at a lower price point to sell using traditional financing metrics.
Exactly.
And so now you're playing with the level interest. But again, you want to be careful at advising clients on doing a seller carry. Does it make sense for them? Is it something that they want to continue to have cash flow versus looking at 1031 exchange options? And do they have great legal counsel set up, get their promissory note, and what is their minimum requirements down to structure this seller carry financing?
So there's going to be a lot more work for us as brokers to kind of roll up our sleeves, really dive into, I guess, the financials and wherewithal of the buyer.
Correct.
So,
and you want to make sense, like, of this project. So if debt was, 4% or 4.5% last year, we're going back to those numbers, right? And if your purchase price, again, going back to that $3 million, if they're putting that 30% down, and maybe it's now this person is going into the space as an owner user, and your seller is just now the private lender.
Yeah.
6 months ago, did the business make sense back then to purchase it at $3 million? If nothing from that buyer's business side has changed, that might be a great opportunity for your seller to get the price point that they want, have continual monthly income, and then structure the deal for this new buyer, favorable financing, and maybe structure it on a 2 or 3 year balloon.
Gotcha. So like shorter terms on, I guess, the balloon.
Right. But you don't want to have it too short where you're putting them in a bad position down the road. So you really want to give them like at least maybe a 3 year balloon or 4 year balloon or 5, kind of lining it up to traditionally what financing would have been even 6 months ago.
Yeah, exactly. And so if you had a client that, say, didn't know the full financial wherewithal of the buyer as well, and they're concerned about potentially the buyer defaulting on this loan, are there protections in place where they can take back the property, or what's there to protect them in that scenario?
Absolutely. So again, I'm not an attorney. So you want to make sure that your client has great legal counsel to help them draft that, but it's set up similarly to a traditional loan, right? They'll have their promissory note. It outlines the terms of the loan, the monthly payments, the interest, and what is the default and cure method to if the buyer is in default of the loan. What happens then? And then you go about it the same way, whether it's like the mortgage or the deed of trust in the foreclosure process, and that would allow them to get the property back.
And then what about the whole, depending on, I guess, the experience level of whoever's watching this, first and second position is something that comes up quite a bit, especially if there is debt on that. And how have you dealt with that in the past, and how are you advising, I guess, the developers and investors that you're working with on the land and multifamily side that might have debt and they're looking at this as an alternative source?
So you want to be really careful. For instance, land, typically the most you're going to get in terms of financing is 50%. Really across the board, whether it's a private lender, whether it's a bank, whether it's a credit union, they really don't want to lend more than 50% on land. Land also has high interest rates. So you don't want to set up a client to be in a position where they're going to default down the road. That's not what we want to do, right? We want to help clients achieve success in their investment goals. So when we underwrite it, we want to be really conservative from the land side and looking at interest rates and try to avoid getting debt on land. The second part, when we're going into the multifamily side, typically if you're going to have a second position, it's going to be something that really is small, that you want to make sure, even if, let's call it 15% vacancy, that the buyer is able to cover the first loan and then that second loan. Again, we really want to focus on getting clients set up for success. And you want to be conservative in underwriting. Typically, traditional multifamily, 5 to 7%. We want to underwrite at 10% and look at the metrics down. God forbid, economy crashes, bottoms out. In this property, we have 15% vacancy. Are you still able to, assuming just this one, bubble of influence is, are you able to make those payments with the first, with the second? If not, probably advise against the client getting in maybe a second position of debt and really focus on how to financial model that asset. Where it's in a worst case scenario, they're still coming out and able to make financial payments.
Cool. Any other questions?
Really interesting. I know there's a lot to uncover when it comes to seller carries, and it probably doesn't make sense for everybody, but there are quite a few benefits both for the buyers and sellers, especially as debt gets harder to get traditionally.
And that's one of the things why we love real estate, right?
Yeah.
Very malleable, lots of options. But again, it's really down to make sure you have great legal counsel. That's number one, great legal counsel. Remember that, folks.
Yeah.
Number two is work with a broker that understands looking at how to structure deals, because that's the whole, in every market, whether it's up, whether it's down, if you're a true investor, what are you doing? You're either buying, you're either selling. And the ones that are most successful are the ones that are getting creative in times of change. And so I want to thank you and hope to hear from everyone soon.
Yeah. Thanks for coming on. And for those watching, don't forget to subscribe to our channel and like the video.
Thank you.
See you next time.